Pineapple on pizza, dogs versus cats, is the earth flat? Did we really go to the moon? And whole life versus IUL are debates that will be debated until the end of time. But when someone really has done the research and is able to back up their argument with data, expertise, evidence, the debate becomes enticing. So regardless of your view on whole life versus IUL, you are about to hear from literally an insurance genius, an insurance prodigy by age, and arguably one of the smartest individuals on the planet when it comes to insurance products. He, like myself, is very product agnostic, that no one product is better than another. They just are. And how they function and how they're educated is what matters. After watching Bobby Samuelson talk about the history of IUL, you'll have a whole new perspective on the industry, and your paradigm will likely change as you think about these products. With that being said, let's dive into it. So I'm curious from your perspective, like how has the journey been, let's say over the last 15 years or so, like in the IUL, like where did it start? Did it transform to? Like, where is it at today? You know, you could talk about AG 49, you know, A and B, the amendments as well, if you'd like to kind of give a history of it over the last 15 years.
Yeah, I'll give you the quick story, because I think, and this is oversimplified, so there are always, you know, little pockets and exceptions to this. But like you, I'm agnostic on products. So one of the questions I get all the time is, what's the best product? There is no best product. Okay, products aren't good or bad. Products are not moral or amoral. They either do what they're supposed to do or they don't do what they're supposed to do. And so it's like, so now you can have aggressive illustrations that are completely unrealistic. That's a problem, but that's separate from the product, right? Product does what it's supposed to do. So when you think back to the original concept behind IUL, what it's supposed to do is that it's a universal life product where instead of crediting fixed interest to the policyholder, you go out and buy options and give them index-linked returns. It's a great idea. I mean, there is nothing wrong with that idea. And the idea is, on a universal life chassis, from a crediting standpoint, you get downside protection with index-linked upside potential. It's a great story. And I think early on for IUL, that was the dominant story. So if you think back to like Ameris, Indy Life, even Aviva, a lot of these companies that were in the space early on really pitched IUL as, think about it as an alternative asset class, downside protection, upside potential in a life insurance wrapper. And they were really pitching it as UL, but with index crediting. It wasn't magical. I think that started to change in 2006. So 2006, a couple of new companies come in the space with really aggressive illustrations. Securian was one, AIG was another one. By the way, AIG had been in for years and had not been super aggressive on illustrations, but then they got in 2006 with Elite Global, 10+% illustrated rates. Penn Mutual got in right around then, really high illustrated rates. And suddenly the sales in the industry started to shift towards the more aggressively illustrated products. So to me, that really kind of kicked off the illustration war, which is really what we've been in ever since. And, you know, it used to be that, okay, what's a good IUL product? Well, a good IUL product is one that offers reasonably high upside potential with reasonable policy charges, does what it's supposed to do from a trustworthy company. After these products came out, it shifted to what's a good IUL? Well, it's the one that illustrates the best. And what carriers realized was there was effectively no rule for how you illustrate IUL. So that's where AG 49 came in to try to standardize that. There was a huge loophole in the regulation that everybody knew. I mean, everybody knew it to the point where I was in Phoenix at the date, because I helped draft that regulation. We were in Phoenix and we were clinking beers at the bar after we got AG 49 approved. And, you know, we were sitting around IUL companies, and I was working for MetLife at the time, right? IUL companies and non-IUL companies. And I remember saying something to the effect of like, hey, you guys know there's a huge loophole here. Like, we all agree on that, and you guys aren't going to do anything, right? And they're like, oh, no, we won't take advantage of it. We don't want to go through this again, blah, 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 blah. Well, lo and behold, right, PacLife comes out with PacLife PDX. We get the multiplier wars. AG 49A comes to stop the multiplier wars. AG 49A was incomplete because it didn't address these engineered indexes that had been, you know, become very popular on the annuity side and kind of percolated over to the life insurance side. So then we had a couple of years where those indexes were the best illustrating thing out there. Then we got AG 49A revision, which I call AG 49B because it's a mouthful otherwise, right? So AG 49B comes along, and that was implemented just in May. And already we're seeing companies figure out how to arbitrage AG 49B and illustrate, you know, rates that are way higher than what they should. And the question is why? Well, it's not because this stuff is better for customers. It's because it illustrates better. And again, you got to separate this illustration from the product. And so back in the old days of IUL, to me, it was all about the product. What's the functional, mechanical, to your point, Dom, like not right or wrong, just mechanically, what does this product do, and how does it work? And that was the selling point. And as it shifted to illustrations, it's just been chasing whatever illustrates the best, regardless of what the best thing is for the client, regardless of what the best long-term performance will look like. And the biggest way we see that is that after AG 49A, the strategies that companies were using to illustrate the best, under any reasonable expectation, actually will illustrate worse than a normal IUL product. And yet actually perform the worst, but they actually illustrate the best. So companies were pitching strategies that they knew were going to underperform.
Wow.
But because they illustrated better, they set them as a default, they benchmarked off of them, and they pushed that strategy. It was shameless. And I think that was when the truth came out, right? Anybody who's watching knew in that moment that it was never about actual policyholder experience. It was always about illustrated performance. And that is a problem. And again, that's nothing on the product. I like Index 2. I have no problem with Index 2 as a product. I have a problem with the way it's illustrated. And that was like the moment when everyone should have known, oh, the illustrations are totally bunk, right? You can't pay attention to them at all because all this is just one huge game. And so that's been the history of the product, really.
When I hear you speak about it, it gives me the chills, and not give me the chills in the right way. It actually makes me sick to know like that's where we're at as an insurance industry, and where it's not just at an agent standpoint, it's actually operating at like these billion-dollar companies are knowing what they're doing, and it's working out this way.